Everyone wishes to be affluent and have enough money to live a happy life. Most individuals believe that accumulating wealth is a difficult task. Those with a steady income are concerned that they will be unable to do so. The truth is that creating wealth is not difficult. It only takes a methodical approach. The stock market is one of the best ways to build wealth. Even for a modest investor, investing in the stock market is a terrific way to build money. Hello everyone, and welcome to a brand new video on the channel. Today we are going to talk about how to build wealth through stock market investing. Before we get started with the video, don't forget to smash the like button, share the video, and subscribe to the channel. Now let's get started. Start with a plan. You must plan any activity before engaging in it. Investing in stocks is no exception. You should plan your investment. The first step is to determine your risk tolerance. The stock market might make you rich beyond your wildest dreams, but it can also cause you to lose everything you own. That is a risk you are taking in exchange for a reward. When you take chances, don't put your life savings in jeopardy. Have money set aside for emergencies and invest a portion of your normal salary in the stock market. Determine how much money you can invest in the stock market. You must create a budget and comprehend your revenue and expenses. Calculate how much money you can save and invest some of it in the stock market. Younger individuals can invest up to 80% of their funds in the stock market, with the remainder in safer products such as bonds. As you get older, you can gradually lower your stock market assets to reduce your risk exposure. All of this necessitates preparation. You must create a methodical investment plan. You can build a plan with the assistance of a competent investment advisor. You can do your own study and planning if you have some financial expertise. Make sure you define your investment goals. Determine how much wealth you want to create and for what purpose. House purchase, college education for children, retirement funds. Make a plan based on that. Your skill in a specialized sector could turn into a profitable enterprise tomorrow. Think long-term and stay the course. Some investors are fortunate enough to strike gold with their investments within a few months. Such tales are few and far between. For the tortoise and the stock market investor, slow and steady wins the race. When you invest your hard-earned money in stocks, you must consider the long term. Don't expect to become wealthy in a few years. Persistence is the key to wealth creation. There is no reason why you cannot become wealthy if you invest for the long run. The stock market provides an average return of 9. When compounded, investing $2,800 each year for 40 years can make you a millionaire. Each year for 40 years can make you a millionaire. It makes sense to invest for the long run. Keep going, and your dreams will come true. It is a roller coaster ride, so hold on tight. It is critical that once you begin investing in the stock market, you do not stop. In this business, time is your most powerful ally. Making money in stock investing takes time, but the key is to persevere. People who have acquired a fortune in the stock market have typically kept their money in the market for extended periods of time, sometimes up to 15 years. The majority of them have yielded excellent results. Investing in the stock market is similar to riding a roller coaster. Sometimes you're on top and other times you're hurtling down. Hold on tight and don't let go. The market has highs and lows. Don't be alarmed if the market falls. It will heal. It could take several months or even a year or two. If you're in it for the long haul, don't be concerned if the bears take control. The bulls will undoubtedly return. Don't lose your sleep. When it comes to investing in the stock market, there is no one rule that applies to everyone. Before considering an investment, make sure you thoroughly examine your situation. Make no investment that you are not comfortable with. If you can't sleep at night because you're afraid you'll lose your money, you probably will. Set a goal for where you want your investment to take you. You may want to earn tax-free interest, protect capital, or produce current income. You should be fine if you know what you want to achieve. Never buy stocks simply because your friends, family, or neighbors do. Make an educated choice and invest in stocks you understand. Do your research before investing in any stock. That will ensure you don't lose your sleep. Create a diverse portfolio. You've probably heard the expression, don't put all your eggs in one basket. This is also true for the stock market. Don't put all your money into one company or a group of stocks. Diversifying your portfolio across instruments and assets is the key to limiting risk and maximizing rewards. There are a few things to consider when deciding how to disperse your risk. Fixed income, real estate, firm growth and value regardless of size, commodities, real estate, emerging markets, and so on are some of the elements. The quantity of stock market investments you make is not as significant as how you disperse your risk. Stocks are classified into several sorts. For example, blue chip stocks of established market leaders are unlikely to lose money and can be expected to expand steadily. You have emerging small and mid-cap stocks. These are the companies that are about to take off and can help you make a lot of money. Invest some of your money in blue-chip corporations and some in small and mid-cap companies. Also, diversify your investments. Don't put all of your money into one industry. For example, if you invest all of your money in equities and the IT industry experiences a downturn, you may end up losing money. Purchase stocks in several industries. This guarantees that your risk is widely spread. Even if one company or industry suffers a setback, there are others to fall back on. Also, every 6 months, reallocate or rebalance your investment in other areas. Don't ever try to time the market. The key to making a lot of money in the stock market is to buy low and sell high. How can you tell which numbers are high and which are low? Time in the market is never a wise idea. Even the most successful investors, such as Warren Buffett, would never execute such a scam. Small investors rush into the market whenever the stock market rises, going with an optimistic investor mood rather than looking at the company's earnings performance isn't always a good option. Rather than attempting to time the market, you should invest over time in a systematic manner. Also, while the market is high, avoid investing in tiny companies. These stocks may appear to be profitable, but they are extremely volatile. Leave it to experienced investors. A systematic investment strategy is an excellent technique for investing in equities. Invest a set amount of money each month to buy specific equities. When the market is at its peak, your overall investment grows. You can buy more equities while the market is down. Small investors should consider systematic investing. Review your investments periodically. You can sit back and relax now that you've invested money, most likely in a systematic investing plan, and watch your money increase, right? No, that is not how the market works. You cannot afford to be sluggish. You chose stocks that were performing well or were likely to perform well. However, you never know what the future holds. You must monitor the performance of the equities in which you have invested. You must review your investments on a regular basis. If the company in which you have invested is sinking and is projected to face major issues, it is usually time to withdraw your investment. Similarly, the industry in which you have invested may have major problems that are unlikely to be remedied anytime soon. These things do happen, and in such a case, you should assess your investment and determine whether to continue investing in those companies or alter your investment. When you develop an investment strategy, it does not last forever. You should go through your plan and make improvements to it. Various situations such as work changes, pay increases, job losses, or family additions can occur. You should reconsider your investment strategy and make the necessary changes. So, keep an eye on your money and your investing strategy. Cut your losses. If you discover that you are losing money on one or two stocks, it is time to reconsider. You must examine these companies' performance, the industrial sector in which they operate, and their future prospects. If you believe the stock has no future, you should sell it. Sell the stock and take whatever proceeds you receive. You can use it to invest in another stock that is performing well and has greater upside potential. These are judgments that must be made quickly or risk losing everything. It is critical that you keep up with the news and are informed of what is going on in the stock market. Book profits. The shares you purchased for $100 may have increased to $1,000. What are you going to do? If you believe your stock has earned enough for you, go ahead and book profits. If you believe the company will continue to thrive, you can always reinvest your gains. When the market achieves fresh highs, book profits. You may always re-enter the market. Don't be in a position where you are watching your profits dwindle and lamenting the circumstances. Don't get emotional. The stock market is a brutal place. It has no room for emotion. Getting emotional and same with stocks you bought because you like the firm or because your father gave you the stock will not help. Be logical and analytical in your approach. Understand what is going on and make it data. driven decision. Never get emotional over a stock for whatever reason. An emotional investor has a low chance of success. That's a wrap on the video. I hope you liked it. If you did, let me know by giving it a thumbs up and do not forget to subscribe. Thanks for watching. See you next time.